All right. Good morning, truly morning, and welcome back to the Money Advantage podcast. Bruce, really excited to join you for this conversation today. We're really going to be talking about this idea of the unseen wealth gap. And I love the conversation as we're really looking to put people in a position of ownership and control of capital and resources and being able to make the best financial choices from here going forward into the future. And I think this conversation is something that is really missed in almost every financial planning conversation because most people are thinking about how do I invest? How do I get a rate of return? How do I have growth on my capital? And they're not thinking about the one primary thing that all of the most wealthy, most successful, long-term, sustainable longevity families really have in place, which is ownership and control. And maybe it's not even necessarily the word ownership because sometimes the capital, the assets that are belonging to a family might not be in their personal name. They might be in trusts or holding companies. There might be different ways that ownership is handled, but they have control over assets. And so, Bruce, I wanted to have this conversation today on the podcast because I think this conversation is going to be freeing. I think it's going to release some people from a false pretense of security from doing what everyone else is doing and following typical financial advising to really be in a position of creating true wealth. And so we just wanted to look at this conversation today and be able to put you in a position of having the maximum long-term prospects for wealth, if that is your goal. Bruce, thank you for joining me for this conversation.
Sure. I think to start out with, I just want to say, none of this is really going to be any advice. We're just going to talk about opinions and, you know, trying to get people to think about why they think a certain way. Um, because, we talk about wealth. Some people, the idea of wealth is to have just enough money that they're comfortable with, and they're not really looking at anything else but that. And the other thing is that some people look at their own personality and say, I have to give up control and I have to do some of the things that we are talking that you should consider not doing because I am not disciplined enough to be in control. And I'll give you an example. I was just talking with some clients yesterday, and they despise the idea of a 401k because they lose control and they're deferring the tax decision into this future. But they admitted to me that, you know, I probably will spend the money if I just, don't have it in my checking account. In other words, they take the money out of their paycheck and put it into a 401k beforehand. And then the other thing I think people we have to be cognizant of is that there are people that have amassed $2 and $3 million, which most people in the United States would say to themselves, that's pretty good wealth in their 401ks or in what I would call typical financial in mindset. So we're talking to people today is if you don't feel like that system has helped you or it's not your goals that you would like to have, that to try to think differently about how you've been exposed to typical financial planning. Let's talk a little bit about this before we get started. So, typical financial planning would say that they want you to give as much as you can into a tax deferred place or to them in a systematic way. A systematic way meaning it comes out of your paycheck first or it comes out of your checking account on a systematic way. They want you to do it as often as possible. And then the tax rules, if it's in a tax deferred situation means that you don't have access to it for as long as possible.
And Bruce,
Then
let's clarify what you mean by they. I love that you're using that term because there is a body of knowledge and information that is persuading, dissuading, encouraging, moving people towards doing this type of thing. And you're saying they, meaning,
people in the investment community, the wirehouses, the people that give financial advice. And by the way, I mean, I'm part of that. I'm a financial advisor, but financial advising has only been around for approximately 45 years because that's when the 401k started. And it has really taken off, what I would say, in the last 30 plus years because they, there's a whole business around gathering assets. So trying to gather as much assets, well, what's the best way to do is what I was talking about, is if we can get you to systematically give us the money, us as in the financial services industry, the money in a systematic way on a consistent basis on the most money possible because you're trying to tell people, hey, you've got to build up this big pile of money so that you can get a rate of return off of it so that you can live in a retirement as soon as possible. But then we tell them, well, but we have to trickle it back to you at the least amount possible because, it might run out and, we have to worry about taxes. So all of this is fear based. It's the fear that you're not going to have enough money and this fear you're going to run out of money. And it's all based upon rates of return. How much rates of return? We have to estimate that over your lifetime. And then we have to estimate the rates of return that you're going to get while you're in retirement. So this is kind of the typical way things have been done for the last 30 to 35 years.
Bruce, to continue on that train of thought. So the typical way of thinking is building up assets, net worth to then retire at a certain date to then be able to live off of that pile of income. And usually it's put in these tax deferred retirement plans in order to accomplish that goal. And so, Bruce, let's just talk as we're kind of parsing out what most people are doing versus what there might be an alternative to do. I think one of the things that comes to the surface is that a lot of times it can seem that the only option to put money into is the 401k because that might be what you have access to because of your job, and that is presented to you on in your HR packet, and you have options for setting aside for retirement. Now, if you're self-employed, you might have access to different tools, and hopefully you have someone advising you about these things and giving you strategies on things that you could use. But usually still in that category of advice, you're usually getting answers that consist of IRAs, SEP IRAs, and if not IRAs that defer the tax, then Roth IRAs that pay the tax first, and then you don't have to pay tax in the future. But Bruce, I think it would be helpful to just kind of talk about what is the spectrum of asset classes, because I think it can be really easy to have this narrow mindset that the only tools I can use are are the holding tanks of tax deferred retirement plans. So things like 401ks and IRAs, or I could use Roth IRAs. But then once I get there, I'm going to put inside of those usually stocks, bonds, mutual funds, and that's usually the end of the conversation. There's a broader range. Bruce, can you just kind of bring up what is maybe the difference between if we're looking at equities, fixed income, cash or cash equivalents, real estate, commodities, alternative investments? I mean, the world is much broader than most people are advised to think.
Yeah, I think before that, let's just quickly say there's also three different tax categories. There's taxable categories, which would include anything that you would have to put on your tax return in that year that you actually deployed the investment. When I say deployed the investment, I mean you either got a 1099 which is the IRS tax code for a dividend or interest, or you sold something for a capital gain. So that would be things in the banking industry. So interest and things that produce dividends. That would be from mutual funds, from other type of investments that produce dividends. There could be things that you sold, a stock that you sold that produced capital gains, or any other type of capital gain from a business or from property that you sold. So those would be taxable. Tax deferred is where we find a lot of people have most of their money, and that would be the things that the IRS has set up that you can not pay taxes this year if you put it into. You defer your taxes into the future, and those would be, Rachel, you already mentioned the most common being the 401k, because that's what employers have. You can do an individual IRA. You can do tax deferred annuities. You can do SEP, simple 457s, 403bs. These are just other types of tax deferred tax codes. And then, of course, with the tax free situation, you could have equity in your home, you could have municipal bonds, you could have uh, life insurance, and of course, you already mentioned Roth IRAs. Now, within this, this is what's interesting, right, Rachel? And I'm glad you made this distinction. Is within those investments, whether they're in a brokerage account, which would be taxable, this is after tax money that you put in that, whether it's a tax deferred account, such as the IRAs, the 401ks, or whether it's tax free account, which is the Roth IRAs. A lot of people say to us, I'd like to invest in a Roth IRA or an IRA or 401k or a brokerage account. They think that is the investment. They don't understand that there has to be holdings within those investments. And that is a clarification piece of where you were going, is only certain things can be held within those particular IRA tax codes. And typically, they are the traditional things like the stocks, bonds, mutual funds. There are now exchange traded funds. There's starting to be some alternative classifications, such as commodities, real estate, private equity, private lending within those, but Bitcoin, or cryptocurrency, we should say, are starting to move into these particular things. However, they are still traded. They are still traded on an exchange, and you are at the whim of the exchange. Each one of them are going to have different tax classifications, and each one of them you're going to have to follow certain rules, like the IRAs, 401ks, the tax deferred columns. You're going to have to follow the IRS rules. The brokerage account, you're also going to have to follow the IRS rules as far as capital gains goes. Now, when I think what we should point out is those are kind of typically what people use, but it is becoming more of the forefront where people are saying, I want something else besides stocks, bonds, mutual funds, or the fringe things such as cryptocurrency and some um, alternative investments that are traded. Now, why I keep talking about traded ones is because traded ones stand on the full faith of what the organization or the community. In this case, we're going to just say the United States, although people trade United States stock market all across the world, but it's what they have the faith in that particular trade it on a stock exchange. So they determine the value based upon their reality, based upon what they're doing as far as studying that particular investment. An alternative to that is you actually having ownership in a particular asset class, which most people call alternative investments. And alternative investments is a kind of a catchphrase for anything that is outside the stock market. And we're being general here, and we're being general in on purpose because there is a plethora of different choices that you really need to get to a financial professional to determine whether they even make sense for you or not. And some of these alternatives also require that you are an accredited investor. And an accredited investor status currently in the United States is a single individual has to make $200,000 a year and have reasonable expectation that they're going to continue to make $200,000 a year. If you're a couple, then you make $300,000 a year and you have reasonable expectations that you're going to continue to make $300,000 a year. And excuse me, or you can have $1 million of liquid net worth. Now, what's interesting of that, because of our Fed's monetary policy, you would think that $1 million is a lot of money, but it really isn't anymore. A lot of people are getting to $1 million. Now, $1 million of net worth, it has to be liquid, so it cannot be the equity you have in your home because that is not liquid. It cannot be equity you have in your rental properties. That is not liquid. It can be um, the amount of money that you have in these tax deferred accounts, even though technically you would think it's not liquid if you're not 59 and a half. But the government says it is liquid because you can get to it
Hmm.
as long as you pay the penalty. So it's kind of I think it's kind of a weird thing that they put. And when I say they, I'm talking about the SEC, the Securities and Exchange Commission, puts these restrictions on the definition. So
So
now
Bruce,
we're
that's a
looking at,
lot. Go ahead.
yeah, I was just going to say, I was just going to say, now we're looking at all these definitions, but now we can pare down to how these things fit into each one of these and why people consider doing them.
I think it's really helpful that you separated not just asset classes, but you talked first about the tax classification of those asset classes because if the only thing you're being aware of or presented with is tax deferred or taxable options, you're not looking at tax free. Or if you're only thinking, I've got to pay the tax now or pay the tax later, you're not thinking about tax free options. And so let's go back to what you said about most people are investing through brokerage accounts and tax deferred vehicles or Roth IRAs. And in that case, you can only do traded assets within those accounts. Is that correct? So,
Well, you can't, this is where it gets a little, there is something called a self-directed IRA, and you can get outside of that. I will say that even at our firm at E3 Wealth, we refuse to help a person with that, not because it can't be done, but the IRS has put so many onerous rules on and the penalties for not following the rules are are so stressful to a person that we have chosen as a firm not to endorse or do those because you make a little mistake and they're time consuming to put in place to keep up with the IRS rules. So I just want to clarify there are ways to do non-traded stuff inside an IRA, but that's the only one that what's called a self-directed IRA. So I want to be very clear. There are other ways, but it's not typical and it's not easy to do.
so outside of the caveat of self-directed IRAs, which you're saying the restrictions are onerous, I know that if you take the money and put it into an investment, you have a certain length of time to be able to do something. Otherwise, you pay more tax and there's more issues with that. So you're saying it's challenging, it's difficult, and it's stressful. So typically within brokerage accounts, tax deferred and tax free, you're holding traded assets. Now let's just clarify between traded and non-traded again. So for instance, real estate is an asset class. You can own real estate, you can own rental properties, you can own commercial buildings, you can own syndications. Now, if you want to own them traded, you're going to go towards something like a REIT, right? Or a non-traded would be owning the physical asset. Can you just make sure that that's a little bit more clear. What is the difference between traded and non-traded?
Well, a REIT, which is a real estate investment trust, um, it can be both traded and non-traded. They just have distribution rules that and what they can invest in that the SEC says that's what constitutes a REIT. We're not going to get into that in this, but the way we say traded or non-traded, let's say a non-traded real estate investment trust is where a sponsor um, gets together and they put up a prospectus or in a pro forma that they give to the SEC. The SEC never approves anything. They never approve they never approve the investment. That's a misnomer. They just say yes, they've given this. We have looked at it. It is actually meets our definition of a prospectus, and they look it all over and make sure that the stuff in there makes sense according to their rules. Then people can fund that, and then the sponsor responsibility is to go out and purchase whatever the prospectus says we're going to do. They may say multifamily apartment complexes. They may say commercial real estate. They may say land. Whatever that real estate is. And it's also going to say the expectations, like we're going to pay you a distribution, or that's our intent. It doesn't mean they're contractually obligated, but our intent is to pay you this distribution from the rents, so on and so forth. And then they'll say we're not intending to do that. We're just going to try to improve this, and then we're going to sell it, and we expect appreciation on the back end. They'll talk about a liquidation phase, and this is the biggest difference between traded and non-traded. Is there's a liquidation phase. In other words, they're going to give an expectation. We believe the portfolio will be increased in 3 to whatever years, 7 years, 10 years, whatever it is. And so they will have a redemption process. And the redemption process may be there is no redemption, all the way up to you can request a redemption that we will consider if we can make the redemption, but it's not guaranteed. Or they will say something that says you can only ask, we can only ask, or the investors can only ask for 5% redemption per quarter, per se, and we will not do any more than 5% redemptions per quarter. If it goes over 5%, the people that are in line they will actually go to the next quarter, so on and so forth. So there's a lack of liquidity in that. Now, Rachel, anytime there's a lack of liquidity in an investment, people expect a higher premium for it, either in the form of distributions or in the form of appreciation on the back end. So that that is non-traded, because if it was traded, you could do the exact same thing and be traded. So it trades on a stock exchange with a symbol, but now you have liquidity because that can be traded every single hour if you want, every single day. So now, if that happens, though, what happens is you normally don't have the same type of distributions, and the stock price doesn't normally go up over the same period. Now, I want everybody to listen to what I said. Normally, it's not 100%. Now, the difference here is that the non-traded REIT, we're just going to use the multifamily apartment complex. Some people that do those, or I should say most people that do those, are doing it for the cash flow with an expectation that there will be a liquidation event in a reasonable time period, 3 to 7 years, and there will be an appreciation on the back end. But they know they can't get out of that particular real estate venture easily. And that is why the SEC puts those accreditation standards on that, because they figure a person that's making that higher amount of money or has a liquid net worth of $1 million or more, they don't need the liquidity. They have other money someplace else. Now, that in a bad time, like interest rates going up, or in an economy that's not very good, they know that they can weather that storm, and they're not going to sell those apartment complexes for either a loss or just for what they bought them for. They want to be able to hold on to them until the economic conditions are better. So that's why they always give a range, 3 to 7 years, and they can all actually go past that 7 years or 10 years or whatever it is. They're going to, and they tell the people that invest in it, we're going to sell this when it makes most sense for the investors. Where if it's traded, it's actually exposed to the whims of the stock market, the overall whims of the stock market. Because in a economic downturn, people tend to panic. And I'm talking about the retail investor, but I'm also talking about the institutional investor. So what happens is the apartment complex can be still collecting all their rent. So there's no difference in cash flow. But because people are worried about the economy, they start pulling the money out and redeeming that stock, selling that stock. And whenever that happens, that is actually a recipe for the stock to go down. So that's the main difference between traded and non-traded.
So, Bruce, let's kind of bring that over into the conversation then about investing versus owning. And specifically, where would you say the difference is between, I mean, is it between traded and non-traded? That seems like where the distinction is in terms of investing in something through the stock market. You're investing, you're benefiting from the ups and downs of that stock price of that same asset. Whereas if you're owning, you are in a non-traded capacity and you have access to all of the things you mentioned, the cash flow, the liquidation event, the appreciation on the back end. Is that the case, or is there something else that's clarifying really the difference between somebody who has more control? Because I think ultimately this really does come down to those that are most successful, and I just want to unpack this for a minute and then come back to this piece. If you look up, and anyone can do this, if you look up the wealthiest people in the world, and we all know for the most part who some of these are: Elon Musk, you've got Mark Zuckerberg, Jeff Bezos, Sergey Brin. I'm just reading some of the Michael Dell. The ones that I'm reading are the ones that you probably recognize and know the companies that they own. Obviously, Elon Musk has SpaceX, he's got X, he's got Tesla. I didn't know he has something called the Boring Company. I wasn't aware of that. Mark Zuckerberg, Facebook, Instagram, WhatsApp, all of what's called Meta right now. You've got Jeff Bezos, he's got Amazon. When you look at these most wealthy people, and again, we're not saying that everyone needs to travel that path, but it's helpful to make the distinction that they didn't just own stock in someone else's company void of decision-making capacity. They stood in a role of decision making and charting the course of an organization. They had a lot more control, and that is what has allowed them to be in the position of being the wealthiest people in the world. And so I think that concept we can bring down even to this level that you're talking about here. How do we invest? And again, maybe that's not your goal to overcome that unseen wealth gap and be in a position of maximum wealth. But if you do have a goal towards that, it would be helpful to understand how to interact with these type of assets in a way that's going to put you in a better position of control. So, Bruce, kind of all of that to come back full circle to where do you see this key distinction? I mean, it seems like it's not just do you own it inside of a Roth IRA or do you own it inside of a 401k? That's not really the main distinction here. The question seems really how do you have the most amount of control?
Yeah, now we're talking about two different things, and it all depends upon each other. So when you own, let's just go back to the non-traded REIT, you don't have a lot of control because you have lack of liquidity, you're the sponsors, you're a limited partner, so you're not running it necessarily, so you have lack of control. However, what the control you do have is you have decided that you're going to put a portion of your wealth into something that's not into the stock market because you believe that a small group of investors have a common goal. And that common goal is based upon the same types of objectives that will not be driven by the general market. So that's the kind of control you have. Where if you put in the general market, you, like I said earlier, this happened in 2022. It's happened in along many different ups and downs of the stock market. Is even if we're just using multifamily right now, there's a lot of other asset classes, but we can't cover them all right now. Even if the rents are still being they're still being collected, the overall atmosphere of the people is, oh, the economy's not good. I'm going to remove my money. So now when you start talking about other control, is I think where you were going is building a business yourself or working with partnerships to build a business. Now you can control all the decision making processes. Doesn't mean you're going to be successful, but you're not at the whims of the overall economy, the overall monetary decisions of the Federal Reserve, the whatever administration is at that time. So you can actually pivot more quickly, and this tends to be a different way to actually give you a sense of control, which you do have. Now, when the people that you were talking about, yes, they have control because they're the majority stockholders, but the majority of their wealth is actually from stocks. So they are still at the whims of the stock market too, or at the particular monetary policy or the particular policy of a government administration that could change. So, but they believe because they are a majority of the stockholder, they could make some pivots that will overcome those different monetary policies or those different administration policies. So it's hard for the common person to say, well, I'm never going to build, and you already mentioned this, I'm never going to build something as big as Jeff Bezos, or Zuckerberg or so on and so forth. But could I build something outside of the stock market that I do control? One that just comes to me, and I'm going to meet with him in the next week or so, is somebody that was working a W-2 as a physical therapist and decided to buy a business in their town that was a popcorn business. So they sold popcorn to different events, mail orders, so on and so forth. And they got it for a reasonable, very small amount, like $35,000. And then they built it up and then they sold it, but they got cash flow along the way. So those are things that a lot of W-2 people say, well, what do you want me to do? I don't have anything to do. I can't build or buy a business. I don't have time. Well, everybody has this perception that they don't have time, but they really do if they prioritize if this is what they want to do. But if they don't want to do that, then they're going to have to just continue in the typical financial planning. And like Warren has said here in our YouTube channel, he says I think that qualified plans are fine as long as people also have substantial level of capital outside the qualified plans. And I agree with that, Warren, 100%. We see more problems with people that are potential clients that have 95 or and some close to 100% of all money in their qualified plans. Because now they say, well, I would like to buy this business, but I can't get to the money to buy the business. So that's a really good example. And then finally, there are investors in individual companies who become very wealthy. For example, Warren Buffett and Mitt Romney. Um, Absolutely, that is true. Now, I'd have to do a little bit more on Mitt Romney as far as how that was going, but Warren Buffett is is a investor that actually invested in other companies. Although Warren, I would say that he still feels like he has control because he's selecting that company, that company that he believes that he will have influence because he has bought enough of the shares of that company to actually have influence on that particular company. So it's still that person feels like they are the owner of that company and has influence on them. So it's hard for myself, and I think you and a lot of people is to scale this down to an everyday person that might be, having a net worth of 500 to $750,000, and they say, well, I don't know what I can do. And then the next level would be an accredited investor that has two, three, $5 million and wants to get more diversification just outside the public markets. But it really comes down to finding financial professionals such as a good CPA that can help you along the way, a good bookkeeper that can help you along the way, a good contracted lawyer that can help you along the way, and a good financial professional that specializes in these types of investments that can help you go outside the stock market so that you get diversification not only within your public markets, but outside the public markets.
Bruce, I think there's so many key pieces of that. I just want to point out a few things. You had mentioned those that, like Zuckerberg and Buffett, that have a majority of the stock in a particular company. So in a different way, they have the influence of being able to not cause a run on the market because they are the primary investor in that company with holding the primary amount of stock. And so if you said that that company traded on the stock exchange is beholden to its stockholders, the primary stockholder that it's beholden to is that person who we've named as the wealthiest person who
Yeah,
has that.
yeah, Rachel, I'm sorry. I know you're on a roll there, but it just hit me. They have redemption rules for these people that are the owners so that they're not able to redeem too much to actually influence the stock price. So there are actually rules to justify what you just got done saying.
I think it's really valuable to recognize that if they're investing in the stock market, but they're doing it in a capacity where they might, I'm just going to make up a percentage because I don't know the percentage, but 75, 90% of the shares are held by that person. It would be difficult for a person who is even an accredited investor to do the same thing using their strategy because they wouldn't have enough to be able to own a controlling, maybe not controlling, but a majority of the shares of a large publicly traded company. And so that was just an observation from what you were sharing. But then there was this other idea that how can we bring down these principles to the investor who is maybe not accredited yet or who is accredited and they're over that 1 million threshold, not including the equity in their home, so maybe they are 2 to 5 million in net worth. And the question really that sticks in my mind is how can that person step into a role of business ownership? I mean, you were talking about the gentleman who is purchasing the popcorn company, and I think sometimes we can maybe just need some spark of creativity to think about options when it comes to owning a business. I think sometimes it can seem so limiting, like owning a business means I have to go own a Starbucks or I have to go, run a Chick-fil-A franchise because those are the box stores that I see on the corner and I can see it physically with my eyes, what I have experience with. I go to that location and I know that people run them. And so what is really interesting is that there's so much capacity and space within business ownership as well. And I don't know all the formal terms of these things, and maybe there's a better classification, but there's service-based businesses, there's starting a business on your own, there is buying an existing business. I'm thinking of people who are in roofing or putting gutters on homes or siding or power washing or fence building, things that people have need of that are service-based skilled labor type of work that's needed in different areas that you could maybe build an expertise or build a team of people who are operate or who can operate in that business. And maybe you're the owner and you're running a team of people who are doing this service. So there's service-based businesses. There are commerce type of businesses where you're selling a physical product, and that could be something that already exists. It could be something that you create. Of course, there's going to be a longer runway if you have to create the product first and then bring it to market, but there could be products that are already on the market that you could step into the stream of selling. And I know that Amazon provides options for some people to be able to do that as well. I'm not extremely familiar. We've had people on the podcast who've talked about that, but I know that a lot of people have built wealth through platforms like that. Then you have you even have people who can create digital platforms. Maybe this is training, this is coaching, this is consulting, this is selling or packaging up your expertise in some fashion and form to be able to serve other people, whether that's through creating content and courses and coaching and consulting. Bruce, I would just love your perspective. I mean, I know I'm not hitting all of the types of business ownership there are. I'm just wanting to expand the the thinking when it comes to business ownership. I think sometimes it can be really scary for somebody who is not a business owner to think of starting something, and they hear the statistics about how many people who are in entrepreneurship and how many businesses fail in the first number of years, and that can be a huge deterrent to somebody who says, I really do want that kind of control. I just don't know how to jump over from being in this position of investing and kind of doing what the typical investor is doing to jumping into that position of business ownership. What would you say to that person?
Well, I think just like in anything, the journey of 1,000 miles starts with one step, and you have to actually educate yourself first on the different aspects of this. One of the things I find interesting whenever I talk to somebody and they're thinking about doing this is the first thing is they try to make it too complicated. They they say, well, I need to set up an LLC first, and I need to get my bank account going and I need to do this. And I'm like, well, have you even purchased the business? Have you even started the business? Do you have a business plan? So on and so forth. And because none of that is required, an LLC or a business checking account, a business credit card is required to start a business. Now, it's a good idea, but it's not required to start a business. The other thing is working with a good business broker in your area would be another really good. It's kind of sad, Rachel, and I don't have the exact statistics, but it's over 50% of the businesses that are started and thriving do are never then sold to somebody else. They just fold the businesses. And so that means there's probably an opportunity to pick up some businesses that were cash flowing that you could pick up. And I think it was Walter Dybel has a book called Buy, Don't Build,
Hmm.
and he talks about this. So you might be able to pick up a cash flowing business that really doesn't take a lot of capital. Now, once again, what is a lot of capital? I've seen businesses that are cash flowing $1 million and they want $2 million for the business. I've seen other businesses that are cash flowing six figures, and they want five or $600,000 for it. And so a W-2 employee that has been investing in a 401k would say, "Well, I don't have that kind of money." There's SBA loans that you could take out, so on and so forth for this. Or you could start, like you said, an e-commerce business. We have really good friends that all they do is sell tea, different varieties of tea, and they've actually increased their revenue by 100% this past year in 2025. And I say, people, you have to be patient. You have to set up your life that you're patient. Much like we talk about cash value, it grows exponentially. So you're not just going to go in business the first day and then expect that you're going to have all the cash flow that you ever need to run the business. So you are going to have some lines of credit, maybe some working capital, so on and so forth. There are a lot of through your chamber of commerce, through your local business development. There's a lot of towns that have business development
Hmm.
uh, organizations that will help you with this. In St. Louis, we have one called Spark that actually helps people with people starting businesses, and they're not for profit. They're people that just want to help other people. So looking at all those avenues, if you're looking to actually grow your wealth outside the stock market. And I think that's something that if a person really wants to get to the next level of not maybe wealth, but security, because I think it's more secure when you do some of the things yourself
Hmm.
than just have it to the whims of the economy.
Bruce, I think there's, again, so many things we could bring into this conversation, but I think another thing that dissuades people from starting out a business, which I would say that everything I mentioned is business. Also, if you go into real estate, that's also business. You're building a business of real estate. And whenever you're doing business, there are certain skill sets that are required that are not typically trained or taught through a W-2 position. Whereas when you're W-2, you're specializing, you're having to really hone in and develop your lane, if you will, to be able to serve a broader organization. When it comes to running a business, you have to understand all of the different capacities, all of the different components of running that. And I like EOS, the entrepreneurial operating system, really talks about kind of the different areas, three or four major areas. You've got sales, marketing, operations, and then finance or admin. And you could break these up in different ways depending on who you talk to and which system you implement. But the point that I'm making is that I think sometimes it can be overwhelming to say, well, I need to go learn all of these things. I need to learn how to market. I need to learn how to sell. I need to learn how to hire. I need to learn how to train and develop. I need to learn the finance component of running a successful business. And those are all skill sets, which are really valuable skill sets then to begin building if you are interested in stepping into more of a position of ownership and control so that you can make better decisions there. Um, Bruce, we've covered so much ground here. I would really like to, as we're getting close to a close, what would you say is the most important thing to really determine? Are you owning capital or are you just investing? What is that maybe question that could guide someone to say, is this ownership? Can I get more towards ownership? What is not the benefits of ownership, but what does that ownership actually look like?
Well,
I
when a
don't know if my
person,
question makes sense, but
well, no, I know, I think I know where you're trying to go for the audience. When because you are owning stock, and I know some people are saying, well, wait a minute, I own that stock. So I don't understand that, if I'm investing that into something else that I'm not doing or have the ability to actually have influence on the outcome. Other than, I guess, if you own Tesla stock, if you buy a Tesla, you have some influence over the stock, very, very small amount. But ownership actually into a business or even into a partnership that is a fund, you can dive in. I tell some of our clients all the time, I can't get the CEO of Coca-Cola or UPS on the telephone and ask them about what's going to happen in their opinion going forward and what are some of the things they're going to do with distribution and sales and so on and so forth. However, if I get into a partnership, and we're going to just stick with the REIT right now, although there's many other things, I can get the sponsor of that, the person that's putting it together, on a phone and ask them as many questions as I want. And we can say, well, what are you going to do here? What are you going to do if this happens? What are you going to do if this happens? If I put in and I'm part owner of this, what is going to happen in this situation? Can I go see this apartment complex? Can I see your records? Can I do this? Can I do that? Can I talk to your CFO? They all say yes. So you have control, and you can ask. Now, people are going to say, well, you can go to the shareholders meeting. Well, that shareholders meeting is run once a year, and there's scripted answers and so on and so forth that go on in that, and there's only a limited amount of time. And if you don't think of your question at the time, then you're not going to get it answered. So I would say being able to have influence when you own something, even if it's just owning something in a partnership that's outside the the stock market. Now, if you actually own your own business, not only are you making all those decisions, you don't have to make all those decisions, though, Rachel. You can also get center of influences to help you make all those decisions that you trust. And actually, the best ones actually do that. So control of the decision making, or at least your decision making, because you can obtain more of the information than you could with a public company. Now you can go through their books and you can look at all the numbers and so on and so forth, but the numbers don't tell the whole story. The philosophy and the vision is much more important, and you're not going to be able to see that in a public entity. They're going to put out press releases and so on and so forth, but you're not going to be able to ask those questions that you want to ask.
Bruce, I'm going to try to bring a lot of threads together as we close this here today. But in terms of owning assets, a couple things that I want to point out, whether that is real estate, whether that is owning businesses, whether that's owning commodities, whether that's owning some of these other things that we talked about, other alternative investments, or things that you are in a position of non-traded asset ownership as much as possible. What can be really valuable to thinking about this is that whereas income is something that you can have today and can be consumed later, really when you're thinking about assets, you're thinking about a producer of income that you want to own rather than just the income stream. You want to own the golden egg that produces that income stream. And if you do have ownership of assets, you not only have an ongoing income stream, so it's not just today, but it could feasibly continue producing income into the future as well. That could, I know we don't like the word passive income, but that asset could be producing asset-based income rather than you producing the income. You can accumulate wealth, you can have more appreciation, you can have a hedge against inflation, you have compounding growth. And I think that if you focus on asset ownership, you could have compounding growth that compounds not just in your lifetime, but for generations that can continue growing and building. And we haven't even mentioned or touched on really, or maybe this is coming full circle to what we originally talked about. You have tax advantages as well when you're in a position of ownership because there are so many more tax incentives when you do own assets, things like depreciation or and I'm not even going to go down a huge rabbit hole there, but there's things that you can write off as business expenses that you're not taxed on because you own a business that are not available to you if you are investing in assets, but you do have those opportunities if you own assets. Bruce, is there anything you need to clarify on what I'm saying there?
No, it's 100% true. Yeah.
I do want to also just mention that utilizing infinite banking is a tool that is ownership. And really what I love about this is that you are an owner of the insurance company if you're using a company that is mutual, that provides dividends to the owners of the policies who are also owners of the company. And because you are an owner, you have more advantages than just if you were a stockholder in a company that is working with a stock company. So there's a couple distinctions there, but when you own capital and you own cash value in a life insurance policy, you're in a position of ownership, you have more control, and that can also be another asset that is producing all of those benefits for yourself in your lifetime and for coming generations. And so I just wanted to mention that the most important shifts that are really happening here are not just where you're putting your money, but it's really a mindset of what you're doing with your capital. And you have to first know, what is your end goal? What are you trying to ultimately accomplish? Is it just is it a dollar amount of accumulation of net worth? Is it a certain amount of income? Is it an income stream in the future? Is it generational wealth? And when you take a look honestly at what your wealth goals are, it will help you be able to work backwards from that goal and set up the steps that will allow you to more effectively get there. And really, if you go from chasing returns on the investment side to really designing systems, you're in a position of ownership. If you go from accumulation to thinking about continuity and about assets that can last, you're in a position of ownership. I wanted to leave off with one additional thought, and that was a book from Dan Sullivan where he said the book is called Who Not How. Dan Sullivan, and I believe that he co-authored that with Ben Hardy, Dr. Ben Hardy. If I should let me check myself. And yes, by the two of them. And what is really interesting about that concept is that often we are asking the question of how do I do this thing when the question doesn't need to be how do I accomplish it, but who can help me get there? And Bruce, you mentioned this as we were talking about all of the things that you might need to develop the skill sets for entrepreneurship or for owning a business. Sometimes those are a who can help you do those things instead of you having to on ramp that learning curve yourself. Bruce, anything you want to share? What would be the most important takeaway for you that you'd like to share as we close today?
That there's just other avenues of building wealth than what you've been exposed to, and having the foresight to go and find out as much information about that. It's not one is better over the other. It's what how does it fit into your personality? Um, and there are a lot of people that are just investing in the public markets that could free themselves from the public market if that's what they want. Because, Rachel, I think there's a lot of people that want that because I hear every day people are afraid that the stock market's going to go down. So there are people that is not what they want to be doing. That's that they just don't know anything else to do. So we're just trying to open people's eyes to other ways to use asset classes to build their wealth.
So if that is you, and if that is something that you are wanting to build in your financial life, because maybe the current goal, maybe the old goal that you had for your financial strategy is not where you ultimately want to go, and the strategies you're using are for that old benchmark, and now you have a new target that might be a lot higher. I would encourage you to reach out to our team. We can help you implement these ideas and figure out what your next step is going to be to help you build that position of ownership and control and be in a position of controlling your future and building amazing wealth. We can have that conversation. Just go over to themoneyadvantage.com. You'll find a link to book on our advisor calendar right on that homepage, and we'd love to be part of your story. Thank you so much. In closing, success leaves clues. So model the successful few, not the crowd, and build a life and business you